Technical analysis, understanding price patterns, trends, and indicators. We use technical analysis to help us understand why price is moving a certain way and in an effort to help us predict where price will move next. Technical analysis includes the tools, indicators, and patterns that traders use to get a sense of what the market is doing. We can use our technical analysis to identify inflection points, key levels or zones where a change in price is likely to occur. A trading chart is a visual representation of price movement. You can customize your chart settings to have different time frames, trading indicators, colors, and much more. Let's look at some of my favorite technical analysis tools. So this is a basic daily chart for what I use here in Thinkorswim, and we can start the analysis from a top-down approach, looking first at the moving averages. Now, moving averages are kind of one of those things that a lot of traders use. A lot of traders will use different values, so I encourage you to find the ones that fit your time frame and your trading personality the best. From there, we have the parabolic SAR. This is what I like to use in conjunction with the squeeze. So looking for moments in time where the market is compressed and is getting ready to make a directional move, and then trying to determine the direction of that move with the parabolic SAR. I use the DMI in a similar way. For the average true range, you could absolutely leave this as just the chart label, but I like to look at the history of it to see if the average true range of this product is either expanding or contracting, and then here at the bottom we have volume. If you would like to use this grid, you can use the link that's listed here in Thinkorswim to open up your charts, and they look like just like what you're seeing here. And if you'd like to see how to do that, you can really just take it and put this link into any browser. So you've got the tos.mx/F0. You can see the link there. And once you've got that, then we'll just come back over, and you can either copy the entire link, or you can just copy these final couple of pieces of it, and then come over and put this into Setup, Open Shared Item, and then we'll paste that into this shared item URL. From here, we'll be able to import our chart, and now you'll be able to look at exactly the same thing that I am using for my basic day-to-day analysis. Now you know what a basic chart looks like and how to read it. In the next section, we'll dive deeper into the basic functions of indicators and why they can be helpful for traders. Indicators and trading tools. Trading indicators are tools that traders use to help predict the direction that price might go. We use indicators to help determine the trend, direction, and support and resistance levels of a chart. This helps us make more informed trading decisions. Some of the basic functions of indicators include identifying the trend, determining whether price is in an uptrend, a downtrend, or sideways and consolidating. Oscillators help us understand if price is overbought or oversold. Support and resistance, understanding which price levels the market tends to show a large amount of buying or selling pressure, which can be useful for entries, exits, and stop losses. Volume, which gives us insight into the trading activity of an asset, and then moving averages, which show the average price over a period of time. There are many free trading indicators available to use. We also have premium indicators here at Simpler Trading that our traders have coded to match their trading strategies, like arrows, colors, etc., to help automate the trading process. We'll cover which specific free and premium indicators that we like to use in the next few sections. In the next section, we'll review a popular trading strategy and which indicators are my favorite when it comes to trading with the trend. Identifying trends and how to use them. Trading with the trend is a popular trading strategy because it keeps traders on the right side of the trend and follows the general direction of price, in theory, increasing your probability of success. The market moves in three directions: up, down, and sideways. Trends equal directional patterns. Again, those directions can be up, down, and sideways. A bullish equals an uptrend. Bearish is a downtrend. And then choppy and sideways is consolidation. One way to identify trend is by looking at price patterns, higher highs and higher lows, or lower highs and lower lows. When there is a higher high, price closed higher than the day before. A higher low, the low of the day, closed higher than the previous low. This could signal a possible trend to the upside and vice versa. In something like Adobe here, this could be identified by looking at it through a high and a low. Then right through there you didn't quite make the higher high, but you did make a better low, and then that trend continues here with the clear and obvious higher high, and then that pattern continues. So that's one example of finding a bullish trend. When there is a lower low, price is lower than the previous day's low. A lower high, the high of the day, closed lower than the previous high. This could signal that price will fall and create a downtrend. So in something like this chart of Tesla, it's pretty clear to see that we move into, like, here's where you have the shift, because you have a low and a high, then a lower low, a lower high, and that proceeds all the way down here to about 220. So that's an example of a bearish trend. As traders, we want to buy or go long when the stock is hitting its low, and short or sell it when the stock is near a top or a high. We can use these levels as profit targets and stop losses to help identify our entries and exits. We can use previous higher lows in an uptrend or lower highs in a downtrend to identify stop losses. We can also use identicators to identify the trend and direction. My favorite free tools include the combination of simple and exponential moving averages, the parabolic SAR, the directional movement index and the average true range, the volume average, and the support and resistance. Support and resistance levels refer to price levels on charts that are hard for price to move through due to large buying or selling interest. They prevent price from moving in a certain direction and can cause trend reversals. For support, the downtrend is expected to pause or reverse due to large demand. In the case of resistance, an uptrend is expected to pause or reverse due to large supply. Traders use past price levels of support and resistance to predict where the market might move next. Here are some ways we use support and resistance levels: for price reversals, for entry and exit points, price consolidation and breakouts, and for confirmation of trends. Types of support and resistance include Fibonacci levels, including clustered zones and symmetry, trend lines, moving averages, and voodoo lines. Fibonacci analysis enables traders to use prior swings to project where price is likely to go next. It enables you to identify high probability, relatively low risk trade setups where the risk is clearly defined along with the targets. By running this analysis, traders can identify support zones for entries and resistance and target zones for exits. This is key in our trading. Fibonacci analysis will always be free, as it's simply a measure of previous moves. There's no secret sauce once you know these proportions. Traders can identify support and resistance zones based on where price has been sticky in the past. This is typically around key psychological values. If you zoom out on the chart, you can see previous sticky points. In the case of Microsoft, we can see where price has been sticky at 220, at 250, 280, 300, etc. Got to remember that there's a lot of hedging that can go on against these strikes as well, and that's part of what will influence them to be somewhat magnetic. Moving averages are a great free tool that enables traders to identify if stocks are sticking with the trend or not. When price is above the moving averages, it's generally following an uptrend, and when it's below the moving averages, it's generally following a downtrend. Meta had been in a strong bullish trend all the way up until the parabolic SAR shifted and the price dropped below the moving averages. Support and resistance levels are key concepts in trading as they help map out potential price movements. Recognizing and analyzing these levels enables traders to identify entry and exit points and gauge market sentiment, enhancing their ability to make well-informed trading decisions. In the next section, I'll review one of the most popular free trading indicators that helps us identify support and resistance levels. Introduction to moving averages. Moving averages basically smooth an average price of a product over time. Many times they are used to identify trends. There are a ton of different moving averages, but most traders watch the simple and exponential moving averages. Moving averages plot the average price history of a specified number of days for a security and can be set anywhere from 5 to 200. The resulting line that's plotted over the price of your chart helps you determine key information about your stock. Price in relation to the moving averages tells me how strong or weak the trend is and if the trend is shifting. Benefits of using moving averages include pinpoint entry and exit points, identifying bullish and bearish trends, and being able to recognize support and resistance levels. The EMA is more responsive to recent price than the SMA because it places more weight on the recent price action. When shorter period moving averages are stacked on top of longer period moving averages, it suggests a stock is trending higher. Most stocks move away and come back to the 21 EMA. Depending on your trading strategy and position, the EMA can offer great trading opportunities. The SMA is less susceptible to noise. When traders see the short-term moving average cross through a longer-term moving average, that usually indicates a change in trend. The moving averages I use are the 5 and 10, the 21, the 50, 100, and 200. The 21 EMA is the most important for short-term trend, structure, and momentum viewed as the price mean or average price. The 50 and 200 simple moving average are most important for holding and building structure that can support the shorter-term momentum. Here you can see these moving averages for the 8, 21, 34, and then the 50, 100, and 200 shown as simple moving averages. Price in relation to the moving averages tells me how strong or weak the trend is, and this is a good visual of assessing that. Here you can see the screenshots of adding these moving averages to your charts in Thinkorswim. Moving averages play a pivotal role in trading by smoothing out price fluctuations and revealing underlying trends. By calculating averages of past price data over specific time periods, traders can identify the direction of a trend and potential trend reversals. Moving averages provide valuable insights into market momentum, aiding traders in making timely decisions, confirming trends, and establishing effective entry and exit points for positions. Now let's walk through some common chart patterns that you may encounter. Chart patterns. Chart patterns are essential tools in trading, offering visual representations of market psychology and potential price movements. Recognizing patterns like head and shoulders, triangles, and flags allows traders to anticipate trend reversals or continuation. The head and shoulders is one of the more basic patterns that's discussed in trading analysis and is pretty stand out, right, in the way that it forms this left shoulder and then kind of the exaggeration into the movement of the head, which helps build out the topping process, and then the right shoulder, which precedes the break. And the head and shoulders is then confirmed when you take out the neckline, and then that implies more movement lower. In the case of a double top, here's a good example in the euro-dollar pair, forming as longs just couldn't push the currency pair any higher. The failure resulted in a 100-point move for shorts for those that took a stand at that double top. A double bottom is just the inverse. We can see here where AMD double bottomed. The strategy would be invalidated if it falls below that double bottom area, and then you can use measured moves to help calculate your targets. The cup and handle is also a very popular and very useful chart pattern. It was developed by William O'Neill and is the idea that the cup helps form the base, and then the handle is the opportunity to pursue your entry in anticipation of that breakout. By studying these patterns, traders can make informed decisions, manage risk, and develop strategies that capitalize on recurring market behavior, enhancing their overall trading success. Chris Brecher, one of my good friends and a trader that I have learned a great deal from, will cover more of his chart patterns later on in these presentations. In this next section, I'll be identifying different candlestick patterns, why they are important, and a few of my favorites. Candlestick patterns. Candlestick patterns are formed by the arrangement of candlestick bars and provide visual cues that help traders identify potential trend reversals, continuation patterns, and entry and exit points. I use candlesticks to visually help with support, resistance, big and short-term reversal patterns. The visual representation of the highest to lowest price from the open to the close during the duration of time is your wick. The green candles are going to signify gains, or candles where the close was higher than the open. Red will be a loss, or a close where you are lower than the opening prices. Some of my favorite candlestick patterns include bullish engulfing patterns, where the highest price for the day and the lowest price completely engulfs or is greater than the previous session, and the body is larger than the previous body. These engulfing candles, generally you're going to try to go with the trend when it's bullish and then against it when it's bearish. The bearish engulfing would be that bearish example where you can see here where that second candle fully encompasses the previous range, closes down on the lows well below the low of the previous session. I usually find these to be most helpful on larger time frames. Then we have the hammer, which in this case you can see how this signifies a reversal by two pieces, one part of which is the wick, which shows us buyers that came in down at that low, which is very different than what you saw in the previous candle. That wick and then closing at the highs can help us identify a reversal. And then the next session, if you can get the abandonment, which is to say that it gaps up, this range is never tested, well then that helps complete the reversal pattern. Candlestick patterns can be helpful for traders as they provide insightful information about price action and market sentiment. Now let's review how to identify price targets and learn more about where we want to exit our trades. Identifying price targets. Before entering a trade, traders will map out where their price targets are. These price targets or exits can be based off of a monetary gain, a technical target, or a moment in time. We want to try and lock in profits as price travels to each planned target. These are some of my favorite ways to determine price targets, using Fibonacci analysis, previous swing highs or swing lows, support or resistance like a previous moving average that may have been respected, psychological values, voodoo lines, and micro voodoo lines. Many traders like to have multiple contracts on a position so they can roll out of trades. For example, if a trader has 2 contracts on a trade, they may want to exit one contract at target 1 for a conservative exit and then leave a runner on in case the trade continues to move to target 2. Price targets are essential in trading as they help traders set goals and manage risk. By establishing specific price levels to enter or exit positions, traders can effectively plan their trades and determine potential profit and loss scenarios. Price targets provide traders with a structured approach to decision making, aiding in trade execution and risk management strategies. In conclusion, technical analysis is a critical aspect of trading that involves studying historical price data and chart patterns to forecast future price movements. It is essential as it helps traders make informed decisions based on market trends, patterns, and indicators. Mastering technical analysis enables traders to identify entry and exit points, manage risk, refine strategies, enhancing their ability to navigate the complexities of the market with greater precision and confidence.